Here, start recording. Let's start. Let me share the slides. Okay, perfect. Can you all see the slides? Well,
yeah, we can see them good.
Great. Well, we will start. We're going to talk a little bit about wheat. Okay, we had WASDE report last week. I think, to be honest, I think the report, even with probably ending stock are probably a little higher than we thought, but in the US, but I think all around the world was positive in terms of prices, okay? Because basically they're gonna be a little less wheat than we thought around the world. And we always start with this just to have an idea on, you know, Texas cash grain prices, just to remember that, how we start, you know, how we have these really high prices in 2022. This was what we call a black swan, those one-time event, you know, that disrupt everything. We will not see these prices unless we have these another black swans. Okay, but prices, you know, basically start going down. The only thing, and start going down because we start, you know, getting out from the drought, we start producing more, and we've seen those prices going down. And lately, this, you know, couple of weeks, we've seen these prices up and around the world too, okay? But a few things want to talk with you. When we see this 2020 and 2024, when we look at this, and if I need to put it here, you know, our what we call our break-even prices of total cost. When I say total cost, I'm including depreciation, every economic cost, okay, that we have. These prices, 2020, we were producing with a break-even price above what was, you know, the market price. And in 2024, those break-even prices are, you know, with a moderate yield, they're still, you know, those break-even prices are above. I think that if we are having the yields here that in Texas, that we, you know, you probably, you know, seen, you know, these wheat fields, they look great. Those break-even prices might be a little below, but those are prices, especially with the basis that we are having, those are prices that are very close to our break-even price again. Okay, so when we look about, you know, sorry, with production, we know which are the major, you know, producers. We have, you know, Europe, China is going to be, you know, this year, and probably, you know, it was last year and the year before that, it was the, you know, the top producer in the world. We have India, Russia, US, Ukraine, Argentina, and what basically, you know, what we got on WASDE is that, of course, we have in Europe, we have some drought, we have some drought also in Russia that is affecting Ukraine, and we also have, you know, some weather events, you know, some freezing days. We have some that affect, you know, in Russia production, and they're expecting a little less yield than normal. Just to have an idea on why that affects prices around the world, Russia became the most important exporter in the world, okay, and Ukraine too. And if we look, you know, all these last years, and we look, you know, what happened. Remember, we have, you know, in 2021, you know, all these years, we thought, you know, the war would affect Ukraine production and Russia production. Well, it did not affect that much, you know, wheat production in Ukraine. Actually, Russia production of wheat increased, okay? And in the last 10 years, they become, you know, between Russia and the most important exporters and suppliers of wheat, okay? So we are expecting world wheat on 24-25 to be a little higher than, you know, to be a little higher than the previous year. And if we look, you know, from 1960 to here, wheat production, you know, has increased around the world, okay? Probably in the US, it increased a little bit, but it remains mostly steady, haven't increased as the rate that increased around the world. This is because, you know, more area in different parts, they start producing, more area, more acreage, and basically they have also better yields. But we have seen this increase in productions, but we also seen is a decrease in, consumption has increased a little higher than production. Okay, so when we look at the last 5 years, and when we look at this in terms of days of use on hand, basically whatever we have of leftovers at the end of the year, with how many days I can live with that. Okay, how many days we can use that wheat. So world, is just going down and expected to go down in 24, 25. World less China, and basically because China is one of the most important importers, is also going down. And the only place that is going up is in the US. Okay, 23, 24, it went up, days of use on hand. And 24, 25, we're expecting with this crop, we are expecting those days of use on hand, those ending stocks to go higher again. Okay. When we look at prices around the world, we have seen, those prices has, gone up, FOB prices in the last couple of weeks everywhere in the world, and not just here. But we see, there is a gap between, the US, and what we have, US, Australia, and Canada. We have, they have the highest prices, and there is a gap between, Russia, Europe, Argentina. Okay, so basically, remember, when we compete on prices, there is a point, there is always, there's cheaper wheat somewhere else. Okay, remember this thing too. We are in a Niño, and we are expecting to be in a Niña. Okay, that may have effect in different regions, probably next year. But we're in a Niño, and just to give you an idea, 15-16 was the year that we have the best crop or the highest yield, and that was one of the strongest Niño. This is the second strongest Niño. Okay, so we are still expecting, a high yield in the US. Now, how high is that yield? It might depend on what happened with Kansas, because even if we are having a great, I think, the yields here, we're probably going to, record, most of farmers I'm talking about here, you're talking about, getting the record high yields, okay, in this area. But when we look at Kansas, okay, which is where we produce most of our wheat, or actually our winter wheat, there is a drought there, and of course they're gonna harvest later, so we might still, get some rain, things might still get better, but so far, there is an uncertainty on what might happen in that area. Okay, and even when we look at crop conditions in Kansas, okay, and when we look 2024, we start 2024 having, even better than 2016, okay, that we have a yield of 57. And now this last, month, we've seen that crop conditions going down below average, which has an average, with their yield is 44. Okay, so we will see what will happen on Kansas. This is, what is giving some uncertainty on the market right now, and probably one of the reasons why we have seen this, some increase these last, weeks on the price. Okay, now 24 US winter wheat crop conditions ratings. When we look at all the US, they're about, what is on average 2024. And when we look what's the reports on their yields, they also report, a yield that is very close to an average yield. What happened with US wheat use, from in the 80s, from now, when we look at food and seed, mostly the same thing from the late 90s to 2024, these last 25 years. The change has been very little, and thinking that we have more people, I guess that, consumption per capita has going lower. Exports, of course, these last 2-3 years has going down, which is, I think it's normal given, how high these prices were in the US compared to other countries. Okay, so we were less, competitive when we need to compare with other countries. So let's have a quick question. Can you see on the bottom right of this table? Sorry, yes. I have something that it didn't let me see that, but if you'll say it, that's perfect. So on yellow, we have the 24-25, and that's the average, that's what was the conditions, what they are telling us. Okay, so basically planted acres, 47.5 million acres, they reduced a little bit. Yield, 48.9, probably a little lower, what we call it on the trend, but it's, close to average. What is the total supply, exports, thinking, probably a little higher this year. Basically, with these prices, we're a little more competitive, and we are producing more. When you produce more, you have more to export. Okay, so ending stocks, we're expecting to be, to increase. Ending stocks about 670 million bushels. We are still below the 1 million, million bushels that we have in 19, 20, where we see, those prices, average farm price below $6, or, even below $5. Okay. And given WASDE, they're expecting, this is WASDE, they're expecting an average price of $6, okay, per bushel, $6. Okay. Now, here. So when we look at days of use on hand, okay, and this is done by Mark Wald, okay, he calculates days of use on hand, and based on days of use on hand in the US, he, estimates what the price is going to be, okay? So they expect about 2024, price to be about $6, okay? And if we look, if we go back here and say, hey, what happened if we have a higher yield or a better yield in Kansas, or things get better, and we expect a little more, and the days of use on hand, instead of going to 143 or 147, goes to 160, the price might be even, probably a little lower, okay, if those things happens. When we look about and we compare this to an index, okay, and you can see, on the red line, that's the index what usually, crop does. And basically when we get to June, July, and, everything that we harvest everything here in Texas, everything in Kansas, most of the area is harvesting. In July, that's what we usually have the lowest price. But we have seen, prices on the board. This is, July Kansas wheat future prices. I think today was about 670 or 675. Okay, so our, we've seen, there is some prices that are probably, higher than the $6, we're talking about. But there is some uncertainty on the market, and we can see those, those prices going a little high because of the uncertainty in the market. And these are two reasons, basically. One might happen with Kansas, and second, because we know that around the world, we are going to have, tighten, ending stocks. Okay, and this is today's, July contract. This is 678. This is, what we have seen these last 2 weeks going up, okay, because basically weather reasons here and in Russia, okay, well, not here in Kansas and in Russia. That might give us, that some hedging opportunities that we might need to think about, or we might need to discuss, when we talk with farmers, they might need to think, this might be some hedging opportunities before we go to full harvest price. Okay, so the other thing I want to look at, and I look at all the prices and I say, well, what is July 24, September 24, December, and even September 2025, and we've seen those prices, even on July 678, they are going higher. What is telling us, that fundamentally those prices in the market, given, the tightened supplies around the world, we see, prices about $7, is basically pushing, keeping prices above, the $6 level. Okay, so with that summary, we have is, we'll have, high input costs, tight margins. Okay, basically, factors of supplies are greater than factors of demand. What will happen on supply is what actually, going to affect, prices. We are going to see less volatility or lower volatility. And of course, we always have, we have weather effects, but we always depends on what happened with the global economy, global trade, recession, impacts, disputes, disruptions, and, all these type of uncertainties. They are affecting too. We are talking about when Iran, Iran, the problems that we have with Iran and Israel. We have seen, we are expecting, Iran buying a little more wheat than normal from a strategic point of view. Okay, just to have more wheat. Also, that help, prices to go a little higher, this last, couple of weeks. So with that, I'm going to leave it to David. Okay, this is my contact information, but you know where to find me. Let me stop sharing. And if you have any questions, please let me know. Okay. And if not, David, whenever you want to start your presentation, you're welcome.
All right. Okay, maybe. Got it?
Yes.
Yes.
All right. Dang it. Keeps popping up little boxes to give me, pointers on how to use Teams, and they kind of get in the way. Hey, well, thanks. Good to be with you guys. Let's jump right in. I'm gonna do mostly cattle. I got a lamb and a goat chart too I want to share. But heck, let's jump right in. I think the most interesting thing happening in the cattle market right now is really beef production. And I drew a little circle around the last 6 weeks of beef production. Again, my blue line is this year, the dotted line is last year, the red line is a 5-year average. And I think it's a surprise to some people that over the last 6 weeks, we've actually produced more beef than we did a year ago. And, I think we'd all say, well, gosh, how on earth are we doing that with a smaller cow herd, the smallest cow herd in decades? And really this comes down to a set of timing. But as we look at, in a minute, the cutout or wholesale beef market, and we could talk about some of cuts and primals within that. I think really I think it's pretty important to recognize that we're actually producing more beef, and I think that's what's pressuring prices down. And then we can talk about some other things that might be a price issue as well. But this is pretty key in the market, I think, is that we're actually producing more beef than a year ago. I would argue this is going to be pretty short term because sooner or later we'll have fewer cattle on feed. But I think this is kind of an important thing and surprising to some people that we're up over these 6 weeks a good, 2.5% or something like that. So a little more beef than a year ago on our market that we're trying to sell. So if we start looking at digging into why, well, I want to show heifer slaughter this week. Now, these are heifers out of a feedlot, going to a meat packer. And we've certainly been slaughtering more heifers than we did last year. That's a big part of this increased production is more movement to packing plants. If I showed you steers are about on top with a year ago, about the same number, but we've got more heifers going to market, and so our fed cattle slaughter is more than a year ago. Now, remember, this heifer slaughter is up because we've been placing more heifers. Even through last year, we had more heifers on feed than we did a year ago. The last cattle on feed report had the quarterly split out between steers and heifers on feed. And we actually still had more heifers on feed than we did the same time a year ago. And so really that movement of heifers to feedlots rather than holding back for replacements is showing up in our weekly number of animals going to packing plants and the beef coming out of packing plants. Total cattle going to packing plants each week is actually a little below a year ago. But it's below because we got a lot fewer cows going to market, both beef and dairy cows, but a few more fed cattle going to market. So that split of beef production is really showing up because we got more of these fed cattle going to market. If we looked at weights, and I'm going to show this with all cattle, the average dressed weights for all cattle. So it includes fed steers, fed heifers, cull cows, cull bulls. But just look at that change year over year. We have a real counter seasonal movement in weights, driving these, that's really driving production higher. We've got higher weights because cattle are on feed longer. We're keeping them on feed longer. We've had some pretty good weather, and so I think that argues for pretty good performance, and that has boosted weights. And we ought to throw in too, we certainly have cheaper feed than we did a year ago. And in the absence of anything else, cheaper corn would lead us to expect some heavier weights. So we certainly have higher weights pushing that beef production up above a year ago. I mentioned cattle on feed. We've got more cattle on feed than we did last year, really through this notion of placing more heifers, a few more head from Mexico, particularly last year, kind of boosting our cattle on feed, and really, again, still kind of robbing from the future to place those animals now rather than hold those females back for replacement. It shows up in more cattle on feed. I've got to do my cattle on feed pre-report estimates. I'm one of the market analysts around the country that does that. I got to finish those by Thursday afternoon early. I've been working on it already. I think as sort of a quick preview, I expect to see marketings up over 10% compared to the year before. And so that would be April marketings up over 10%. I think I do expect placements to be down. Our data that sort of gives us an indication of placements, both would, or all of those would suggest reduced placements in April over a year ago. And that would get us, depending on how big placements are, or how much smaller than last year, that'll dictate whether we actually get below a year ago for May 1 cattle on feed. I think it's going to be pretty close. Where, I think I sort of tend to the side of the likely that we will see May 1 have fewer cattle on feed, which will really start the clock ticking for really reduced beef production as we get fewer supplies on feed, reduced placements, and fewer animals going to packing plants. So I think that sort of argues maybe for some boost in prices later in the year, maybe even a little counter-cyclically, because of more, because of that timing shift of the number of cattle on feed. So this idea we've got more beef production domestically than a year ago. If we take a look at net beef imports, so what I've done here is I've taken our beef imports by volume and I've subtract our exports from that, and we're importing more beef than we are exporting each month this year. And I think I've talked about this before, that we ought to expect that with prices where they are, that our imports are going to be larger and our exports lower. It's exactly what we're seeing. And so, really, if we add up this change to a year ago in imports minus exports, we get pretty close to 1 pound per capita more beef production just from this net trade position compared to a year ago. So it's boosting our beef supplies. And we add to that over the last 6 weeks that we have more domestic beef production. It really means we got more beef supplies. We've got more supply on our market than we did a year ago. And I think we ought to kind of keep that in the back of our minds, is why are we seeing the cutout struggle? And I'll show you the cutout. If we look at the cutout over this last 5-6 weeks, we've actually had the choice boxed beef cutout, sort of a measure of the whole wholesale market. We've had that value lower than it was a year ago. And I think there's been a fair amount of worry and consternation about why is the cutout languishing like this. Well, I think we ought to consider, we really ought to consider the effect of supplies in there, that we've got more beef on our market. And that's likely pressuring the cutout. Now, some other things we might consider is, are we seeing some consumer pullback from the beef side of things? Are income pressures changing people's purchasing? I think it's what we ought to see with high retail prices, is people buy less. And that's normal quantity demanded, kind of an economic theory type thing. As price goes up, we buy less. I think the question is, do we see some shifting due to relatively cheaper chicken and income pressures on consumers? I think that's really the part where we don't have some good evidence, but the evidence we do have is, some pressure on the cutout because we got more beef production. What we might suggest and think about is that later in the year that production's going to decline, and that gives us some possibilities for some certainly higher beef prices, at least in the wholesale market. One of the things I'm looking for when the next CPI comes out, Consumer Price Index, and look at that beef, the beef side of things, is do we see some effect of this lower wholesale market reflected in lower retail beef prices? So that's something I'm looking forward to when that report comes out, because there is certainly movement together of those. So I'm watching for that in the next CPI report. We'll do a couple of little live cattle price charts. We certainly had a decline in the calf market, but a little bit of rebound in the last couple of weeks. Really, I would argue with a little bit higher fed cattle prices in the last couple of weeks. We certainly got that correction with some lower prices. I think kicked off, if we were looking at the futures market, really sort of kicked off by HPAI. But I really, I think we had a futures market that was pretty darn high, and folks looking for a reason for it to go down. And the reason shows up as, oh gosh, let's get scared about this. Yet the real fundamental reason going on is really larger beef supplies. So we got some rebound, and I think I'd look at that overall level of calf prices, and those are pretty darn good calf prices. Certainly better than last year, certainly better than a 5-year average, and still, not all that far from record high territory, even though we talk about some corrections. Those are pretty good prices. If we look at the fed cattle market, fed cattle have been up a little bit in the last 2 weeks. I think last week, I didn't get last week on the chart. Last week was up a little bit compared to the week before. So, some strength in the live side and some weakness in the wholesale market. So that's really where we are. And I think the big thing to consider is really this notion of beef supplies, that is weighing on the market. Now, I've been looking for some, if we were going to see some really boost in kind of grilling season demand, I was really looking for a pop in some of these wholesale prices already, because we got Memorial Day in 2 weeks, and that if we had a real boom in purchasing going on by consumers, we should have seen a pop in those prices, and we haven't yet. In fact, if we look at some of the kind of these wholesale prices for some of the cuts, we have ribeyes below a year ago. We do have New York strips and things like that above a year ago. So strips are higher, which typically are less expensive than ribeyes. Ribeyes are lower, and we've got lower prices for a number of the other sort of wholesale cuts and primal cuts as well. But we haven't seen that kind of pop in those prices that we should have seen if we were going to see a real boom going on. If we look at some of the retail featuring data by USDA, it would suggest that we have less grocery store featuring going on or specials on beef than we did a year ago. And if we dig down into the cuts, we've got some cheaper ribeyes than a year ago, but more expensive strips, just like we see in the wholesale market. But overall, a little less featuring on beef, and I think that's reflective of it may not be they may have matched their needs with their supplies with what they think demands are going to be over the next couple of weeks without running specials. So I think that's an interesting set of data as well. I'm going to jump a little bit of lamb. I thought I'd just show these are 60 to 90 pound slaughter lambs. I kind of like to average these markets, but I would highlight a couple of things. This is the same chart I used on RFD TV last Wednesday. This price chart. We do a little weekly hit on RFD on Wednesday mornings, kind of talking about the lamb market. And, you know, if we look at it, I'd like to point out a couple of things. One is look at that week-to-week volatility in prices. It's hard to find a market with that kind of volatility of wide swings from week to week. You'll notice, I think we've seen our Easter holiday surge in holiday-driven demand, pushing those prices higher. And we've got our post-Easter happenings going on in terms of price with rapidly falling prices. Looks a lot like that 5-year average in a way. With we get past the holiday and prices start coming down. I think the other thing I'd point out in this market is we continue to have prices better than they were last year. So I think that's a bit of good news. If as we look at the lamb market I think we're rebuilding some price after a real price wreck and some difficulties. So anyway, I think that's a positive, but I think that volatility in prices is something worth noting. But price is kind of moving along with kind of this seasonal pattern. If I take a look at some goat prices, just San Angelo number ones, prices, you know, pretty darn close to that 5-year average. We tend to see prices increase in the spring and begin to tail off. I think we've hit that peak and we're starting to tail off already. Without that peak we had, that really great peak we had a year ago. But we do seem to be having prices that are a little below that 5-year average, but really kind of showing a normal seasonal pattern for prices going on these on the number ones. You know, I don't know. I tend to use a chart of number ones. I also do a chart of number twos. They have continued to be $60 to $80 lower than the number ones. Gosh, I tend to stick with you thinking about these number one prices. If somebody wants a number two price chart, let me know. I'll send it to you. I tend to track both of them. But anyway, we got that seasonal pattern going on as well. You know, with all the talk of HPAI, I'm gonna suggest a book if you're really if you're looking for something to read. This book called The Great Influenza by a guy named John Berry. This is about the 1918 influenza, and I'm going to suggest 2 chapters out of this book. Is really chapters 7 and 8 really do I think a really good job talking about viruses, what they are, how they work, how they mutate, and I thought a really good simple explanation on how they're named. So this current HPAI outbreak has been H5N1, and it's got a good description of sort of how those things work, why they're named that way, and how. I think, I continue to get some calls about this. I think it's pretty darn positive that in the testing of ground beef supplies in states that have had HPAI in dairy cows, everything's tested negative. And I think that's some real positive news for the beef market, even though those concerns are still out there. If you're looking for something to read, I thought that was a pretty good book. So with that, I'm going to end the show. Maybe.
Thank you, David.
Stop
hey,
presenting.
Any questions for David? There was a comment in the chat, David. I don't know if you see it.
Yeah. I think I saw that same headline about, Cargill taking a stock hit. Remember these, all of these, all of our beef packing companies, um, we're going to, they're going to continue to struggle for cattle supplies. And remember, cattle go in and beef goes out. And as we look at these higher fed cattle prices and pressure on the wholesale market or that cutout value, then I would argue the market has really, if there's a segment of the beef industry that's taken the biggest hit in this in terms of their margins, it's the packing side. And so I think all of our meat packing companies are struggling, likely with negative margins, and have been for quite a while now. In this pressure on the cutout, with a cutout under $3, combined with another little increase in fed cattle prices over the last couple of weeks, has just pressured those margins tighter. So I think whether we're talking about any of these publicly traded companies, as they release quarterly earnings, they're going to talk a lot about their losses and pressure on their corporate earnings, from really negative margins and operating in the red on the beef side. And if you think about it, these tight cattle supplies are going to be with us for several years. And so, they're going to have a long time of that to go with just pressure on their margins. I think that's a great question.
Pancho, can you see my slide?
Yes, sir, I can see your slides.
Okay. All right. Well, sorry for the earlier technical glitches, but let's get into the cotton situation. Here's a picture of old crop cotton futures in blue and new crop in red. You can see there's in this calendar year, since January, we've had a great big rally in the old crop and a not quite so big rally in the new, which peaked in March, and then there was a sell-off, and they've come back down. And so as of this morning, the cotton futures market is trading in the mid to upper 70s after taking quite a tumble. So a lot of drama. I'm going to focus mainly on the new crop outlook, which is the supply and demand numbers for which are summarized in this far right column. These are the numbers that came out in the May WASDE report that the market is always anticipating on the grain side and on the other crops, as well as for cotton. They look forward to USDA's first comprehensive cut. So this is a quick summary of what USDA is forecasting. They're using their prospective plantings number 10.67 million as their estimate of planted acres. They're assuming 15% abandonment. They're assuming an average 842 pound yield, and that is going to wind up with a 16 million bale crop, bringing in 2.4 million bales from the previous year. That gives us a rather healthy supply of 18.5 million. And they're kind of bullishly expecting to export 13 million of that and wind up with, here at the bottom, 3.7 million bales of ending stocks, which is a little bit higher than the previous year. We're going from 2.4 million to 3.47 million. We're still under 4, but it's a gain. It's an increase in the leftovers year over year. And so that just the interpretation of this right here would be that we would expect prices to be modestly lower for the 24 crop compared to the 23 crop. That's how we would interpret a higher ending stocks number. But there's a lot of moving parts, so let's look at some of those. Pancho already showed you this ENSO forecast, the La Nina El Nino forecast, and just to repeat what he said, we're expected to transition out of El Nino into neutral. What we're talking about on this scale is how hot or cool the Pacific is. The El Nino means that the Pacific waters are warmer than normal. Neutral means they're neutral. And then they're expecting by the end of the summer to be in a La Nina condition, a 60% chance of being in a La Nina condition, which means that the equatorial Pacific waters are cooler. Now, there's some debate about what this means for weather for the 24 crop. I'm going to point you to this map here and look at the lower map. This is one estimate of what La Nina's impacts are on the summertime weather this June, this August. And you'll see there's nothing here in that red circle. It affects other parts of the world. It'll rain more in Asia. It'll be drier in Australia, which is important actually to the cotton market. This could mean more rain in India, which would be important to the global cotton market. But the near-term effect of a La Nina coming on at the end of the summer doesn't necessarily mean anything for summer weather. This means the expectation is normal, just normal summer weather. So you could sort of summarize, or I would summarize this by saying we're getting the effects of the El Nino even now with some of these excess rains that we've had. And that's going to transition to just normal, good old hot Texas summer weather, which will probably last to the end of the season. Now, you'll hear some people say, there's a La Nina coming. It's going to be blazing hot and dry, and the August is going to be damaging to the crop. I don't think that's what this interpretation says, but there seems to be a matter of debate on it. So we'll have to see. There's some question about what the August weather will be and how it will or won't impact the 2024 cotton crop. So again, we'll have to see. My interpretation is I'm kind of expecting to start off certainly better than we've had in the last 2 years, and then to have a normal growing season. And if it's dry when the crop is maturing, so much the better. We like dry conditions for the sake of maturing bolls that have already filled out, maturing those bolls, opening them up, not damaging the quality in any way. So we'll have to see. There's a few things on the demand side that are still sort of up in the air. I used to call this slide tailwinds, but I don't know if it's a headwind or a tailwind. Inflation has come down, and the Federal Reserve has not been raising rates anymore, but they're keeping rates kind of where they are. And there's some talk about, well, are they going to actually cut rates? And there is some expectation that maybe at the end of the year they might cut rates, but there's kind of a debate on when that'll happen. So it's kind of still up in the air. And meanwhile, interest rates are still at a level that would probably be putting the brakes on the economy, tapping on the brakes, or at least not tapping on the accelerator yet. So we'll have to see there. Other things, what we want to see is for the sake of cotton demand, we want to see the economy growing. We want to see increasing employment, and that has a specific cotton implication. It means that, people might buy some new clothes when they start a new job. We want new employment, and we want new housing, expanded housing, more housing, because we want people to be buying sheets and towels, doing what my wife does every house that we've moved into. And we've moved into 5, and she did the same thing in all of them. She bought new furniture regardless, and new towels and new drapes and new sheets. And that's what we want to see from a cotton demand standpoint. And so to that end, we haven't had the best news as far as home sales. It's been declining. So that's not good. And I have a slide here about other things we might have to worry about, not to get political on you, but if the Trump administration gets reelected for a second administration, there's some talk about him imposing tariffs on other countries, and that's generally not good from an agricultural standpoint. I don't think it would be good from a cotton standpoint, and particularly if it ticked off our Mexican neighbors to the south, who are major buyers of U.S. cotton, or if it shrunk Chinese apparel imports into this country, or if otherwise made China mad and we got into another trade war like we did in the first Trump administration. That wouldn't be good. So let's just hope that doesn't happen, but it's out there. A summary of what USDA is projecting and what I was already projecting is that I'm expecting a little bit of increase in the planted acreage over what they're assuming, the 10.67. I would expect we probably have more like 11.2, 11.3, 11.5 million. So probably a few more planted acres. And then if you assume average abandonment and average yields, we can have a 16.5 million bale crop pretty quick. And then if demand isn't decidedly, if demand is just the same and we have a larger crop, I expect to have more left over, which is what USDA is already projecting, and modestly lower prices. And to that end, I could see prices following the normal seasonal pattern, which is reflected by this blue line here. This is an index, basically just saying that the highest prices of the year tend to come here at in late June and in the first half of the year, and then we tend to have lower prices in the second half of the year. That's what this index, this numerical decimal scale shows you. The red line is the actual new crop futures, and you can see they were following the normal seasonal pattern, and then they got dragged down. I don't know if that's an early version of this or if we'll have some recovery. I expect we probably will have a little bit of recovery in the second quarter, because that's normal. There's usually the market's trying to figure out what's been planted, what the growing conditions are, and that sort of thing. And that uncertainty tends to boost prices, tends to give us this pattern. So I'm thinking we'll probably have prices trading somewhere in the middle here, somewhere in the mid to upper 70s, maybe into the 80s, maybe. It would take a lot. And then lower prices towards harvest time, like back where we are now, mid 70s, even lower 70s. So it's not a particularly bullish price outlook, but if it follows the normal average seasonal pattern, that's kind of what I'm expecting to see. And that would sum it up. So I'll kill my slides, and I'm happy to answer any questions anybody might have. Otherwise, thanks for tuning in and listening.
Thank you, John. Hey, any questions for anyone? John, David, or me? If not, we'll see you next month. Okay, thank you everyone for joining today. Thank you, John and David. See you next month.
Take care, everybody.
We will bring more news.
Thanks,
okay. See you.